What's up, guys? What if I told you that with really good tax planning and strategy, we could save, thousands of dollars in taxes, and someone who is bringing in retirement over $100,000 from various income sources is able to have $1,000 tax bill? What if I told you that that same person could save thousands of dollars in health insurance costs with really good planning? If you watched our video last week, this is a continuation of that video, because in that video, we were discussing health insurance planning. What are your options? And one of the core options that you need to be aware of is the ACA marketplace and how to utilize those ACA tax subsidies to your advantage. So we're going to be talking about that. We're going to be talking about strategic portfolio design. And there's even going to be a little twist with buy, borrow, die at the end. Yep, crazy. All in retirement. I promise you, you don't want to miss it. Welcome back, guys. Be sure to hit that like and subscribe button if you like today's content. And of course, if you need this type of planning, the type of tax planning that we're talking about today, don't be shy. Reach out to us at www.modernwealth.com. That's modern spelled with no vowels, wealth.com. Let's go ahead and dive into it. So if this is your first time here with us, you know me, every once in a while, we will do a case study similar to this. So here's the background. Okay. This is Homer and Marge sample. They're both 57 years old. Marge has been retired for a little bit now. And Homer just retired this year in 2025. Big congrats to Homer. However, Homer had a couple months of work under his belt. Okay. So he worked for Q1, but April 1st is his first day of retirement. And this is the nest egg that he's built up for himself. He's in a pretty good spot. He has a small kind of play around brokerage account here. He has $50,000 in the bank in straight cash. He has a brokerage account that is just a low basis stock that he got for $1 a share. So $1 a share with a cost basis of $50,000. So if you're doing the math there, $20 a share and purchased at $1 a share. So 50,000 shares. So that's a big chunk of the portfolio, and kind of a curveball in this whole situation. And then, of course, him and Marge have been diligent savers, putting the money away into their 401ks. Now, the $1 million question, now that Homer has retired in his 50s, right? He's 57 years old. Marge is 57 years old. There's no income coming in. How does he not only live off of his portfolio, but what does tax planning look like with this type of situation? So let's go ahead and pull up that tax plan. And the tax plan that we're going to pull up is one that I would say is pretty minimal tax planning. Okay. This is the type of tax planning that we see with retirees who are, maybe they did some Google researching, and they piecemealed a little bit of retirement planning themselves. Okay. So this is what we're working with. So Homer had some W-2 income. He contributed a little bit to his 401k. You can see that here. Gross income was actually 48. Put $10,000 into his 401k right before he retired. He only worked for 3 months. Was able to bring that down to 38k. He has a little bit of taxable interest spitting off of that 50k sitting in a high yield savings account. And then that stock that he has spits off qualified dividends. So for the purposes of this, we went ahead and projected out what those qualified dividends are. So it's going to be $12,400 a year. And then what we have is that Homer is going to go ahead and take taxable distributions from his retirement account. He's going to take a gross amount, remember, gross of $132,003. That's a gross amount. And you're wondering why such an obscure number. When you retire and you have to take money out of your retirement account, remember, you have to factor in the fact that taxes are going to be owed on those distributions. So typically there is going to be tax withholding on that amount if you leave it in a 401k. 401ks typically are going to withhold 20% withholding. So this number here, Homer needs 11K net every single month. Okay, starting in April 1st, he needs 11K every single month. Now, if you're thinking, well, that's a huge number to take out, remember, he has to withhold on the federal level and on the state level. So that's how much he needed to take out on a gross amount in order to net out that 11K. But notice that he's exempt from early withdrawal penalties. So to Homer's credit, he went ahead and he took advantage of the rule of 55. And what rule of 55 is that some 401k plans, once you turn 55 and you've retired, can take money out of your 401k without any penalty. And that's exactly what we're seeing here. So kudos to him. He pieced up. He did that himself. But here's the issue. Total income here. Total income for the year is going to be $184,000. We have adjusted gross income of $184,000. He'll take a standard deduction. Taxable income gets down to $154,000. But here's the big issue. Okay. Homer is at a crossroad, and we're just going to assume that he's going to go with an ACA policy. Okay. So again, if you did not watch last week's video on what the ACA is and what your health insurance options are, in a nutshell, taking an ACA policy, especially if you retire years before 65, I mean, we're talking, 57, 58 years old, and you don't have a massive HSA built up, then you are probably going to be a good candidate to utilize an ACA marketplace policy. Now, what we're assuming here is that he opts for a silver plan, okay, a silver plan and the second lowest premium amount. Okay, so second lowest premium amount on a silver plan. And that for him would be $1,416.48 a month. That's just the raw sticker price without any subsidy. Now, based off of his tax situation, he would qualify for $993 of premium tax credit. Okay. Remember, he only needs this for 9 months in 2025. So this is going to help offset all that health insurance cost that he has by maybe $100 a month, right? Not really moving the needle significantly. Okay. So we fast forward and let's just do some quick math here, right? Let's just say he's paying $1,300 a month for health insurance. He has 9 months of that. It's $11,700 in health insurance premiums that he has to pay. And then on top of that, we get to it, he has to pay $22,929 in federal income tax, right? That's a good chunk of change. So what if we approach this a different way, right? So notice here, scenario 2, and I'm just going to show you the end result here. Scenario 2, we're able to pay only $1,000 in federal income tax, $1,000 in federal income tax. And let's fast forward here, get $4,271 in premium tax credit. Okay, so that reduced our healthcare costs by about $4,300, and we save almost $22,000 in taxes. How did we get to that result? Well, let me go ahead and break it down for you guys. So the W2 income remains the same. That doesn't change. The taxable interest that he has coming off of that high yield savings account, again, just as a refresher, if you guys forgot, right? This $50,000 bank account is generating some interest, right? We factored that in. The dividends that this stock that he has in a brokerage account, right? That's being baked in as well. But take a look here. This is a big difference right here. Notice that we aren't taking out any money out of his 401k this time. Okay, no money is being taken out of his 401k. And you're probably thinking, well, how is he going to live, right? How is he going to supplement his income if he's not going to take money out of his 401k? Well, there's two primary ways that we are going to do that in this scenario. Okay, we are going to strategically incur $65,000 in capital gains, long-term capital gains from that stock that he has. So $65,000. If you're going to do the math, right? Because remember, Homer needs to have $11,000 in income every single month to supplement his living expenses that he wanted, right? So if you do the math there, that's going to give us about $69,000. If we were to sell $69,000 worth of this stock here, this low basis stock, we're going to incur $65,000 in long-term capital gains. So we're going to eat that. Okay. But then the other thing that's not being baked in here is we are going to borrow the roughly, extra 40K or so that we need to fulfill all of his income needs. We're going to borrow that from the portfolio, utilizing a securities-backed line of credit. Okay. Or what a lot of people talk about is buy, borrow, die. Again, I want to highlight that because all these financial influencers, right, that I know aren't financial planners, that aren't tax planners, that just heard about buy, borrow, die on TikTok, like it's some cool strategy that Elon Musk and Jeff Bezos use. Yes, that's true, but in reality, this is how it's applied, right? This type of situation right here. What we're going to do with buy, borrow, die here is we're simply going to borrow against that stock. We're going to float 40K. And again, as a planner here, I'm pretty comfortable borrowing only 40K against this stock because the risk of a margin call is low, right? It's pretty low. And there's other things that we can do to protect ourselves if needed to hedge against any risk of that happening, right? So we're going to borrow against that. We're going to owe some interest on that line of credit. But am I okay paying maybe $2,000 in interest on that line of credit to give us our cash? Yeah, absolutely. Because if we keep going along, we keep going here, you're going to see, right? Total taxes saved. We saved about $22,000 in taxes. And because now our income qualifies us for a lot more premium tax credit, we're able to save over $25,000, $26,000 this year with that type of strategic planning. Now, if you're looking at this and wondering, well, how the heck does he owe exactly $1,000 in tax? And how come he didn't have to pay long-term capital gains tax? Well, a couple of things to keep in mind. Number one, with long-term capital gains, you can actually qualify for a 0% long-term capital gains rate if your taxable income is below, I don't have the chart in front of me, but it's roughly 98K or so, right? Taxable income if you're filing a joint return, right? We strategically didn't go all the way close to the line. We stayed a little bit away from it because I didn't want to accidentally go over. But in this case here, because we were below that threshold, his long-term capital gains rate is, guess what? 0%. So he pays no tax on those long-term capital gains. And because his income is so low, right? His only form of ordinary income that he has is he has his W-2 wages of 38K and he has that taxable interest, right? Add that to that. That's 40 in ordinary income. And then his standard deduction takes that off, right? Now he's down to only $10,000 in taxable income. Him and Marge in this situation are paying 10% tax on that amount. That's how you get $1,000 here. That's how we save so much. So there you have it, guys. That is an example of how you can utilize different buckets on your balance sheet once you retire to not only fund your retirement, but be really savvy and keep your taxable income low. Right? You're taking advantage of different rules, right? 0% long-term capital gains, rule of 55 in this scenario, being really strategic, utilizing leverage in a healthy way to create some liquidity, taking advantage of ACA premium tax credits. And again, this is just an example situation, and I'm sure your situation watching this is probably different. But the thesis remains the same. You can plug in these different rules and be creative from a tax planning perspective to create a lot of tax efficiency and also help reduce your healthcare costs in the scenario that we just looked at. I hope you guys found this entertaining and educational. If you need help with your own retirement plan, by all means, you know who to reach out to. www.modernwealth.com. That's modern spelled with no vowels, wealth.com. Signing off, guys. I'll see you next time.